So we have a very interesting topic today, which is the significance of policy change and implications on the insurance industry. So we just heard Mr. R.K. Nair talk about what's happening in the global world of the policy making. He made a very interesting observation that we might be moving towards, at least in some countries, a regime which is different from being rule-driven to more policy and framework-driven. Now, in that context, if we see and reflect upon the Indian insurance industry over the last 15 years since it opened up to private competition, we've seen a significant growth in the industry, even in terms of the way the premium has grown. So, for example, life insurance industry has actually grown from about 36,000 crores in 2001, and now it's actually close to around 3 lakh crores of premium. The non-life industry, which is the general insurance, has actually grown from about 10,000 crores to close to around 78,000 crores. What's very interesting is that over the last 15 years, India has created a new category of health insurance, which is very unique to this market. So if you see 2001, health insurance was about 1,000 crores, and today it is close to around 14,000 crores. So 14 times growth. In the entire world, I mean, and we have a lot of discussion at the global fora in terms of health insurance. I mean, no market in the world other than the US, South Africa, and now India has some semblance of a developed indemnity-based health insurance model, because all other models are more linked to benefits, or they are small players. So we've seen global models emerge in India, and that's a very interesting thing over the last 15 years. What also happened is over the last 15 years, there has been a significant change in the policies. The regulator and the government has paid special emphasis on the protection of the investors and the customers. There has been a lot of focus to increase penetration in the market. There has been a lot of focus to make the products more customer-centric and more customer-friendly, and there's been a big endeavor over the recent years. So if we go back over the last 4 to 5 years, there have been significant regulations which have been brought in to bring in a lot more transparency in the entire insurance business. So whether it be the 2010 guidelines on ULIPs or the 2014 on the more traditional products on the life insurance side, health insurance has seen regulations from 2013 onwards. Also, there have been a lot of draft regulations for discussion. So there's a lot of debate happening on the entire model on microinsurance, because if we see globally, microinsurance and is defined differently in different markets, but typically the idea is how do you penetrate low-income households? That's the standard definition in most global insurance markets. There's been a big emphasis from the regulator and the policy makers on microinsurance. Also, open architecture of distribution. There's been a lot of debate in different forums. There have been different discussions, both by the banking regulator, the insurance regulator, and obviously they're still awaiting final clarity. But there is a lot of thoughts around how do we have an open architecture. Can you have a model of broking for banks? Can you have a model of independent financial advisors? Can you have insurance marketing companies? Can you have a model which is more entrepreneur driven? A lot of thoughts and a lot of debates in the market on architecture for distribution. But what we've seen over the last 4 to 5 years is that while a lot of the policy has been focused on increasing penetration, has been focused on making the products more customer friendly, more customer centric, but you've seen a lot of significant impact on the business models of insurance company over the last 4 to 5 years. So a lot of the policy changes which have been come in have led to fundamentally a lot of insurance companies trying to change the entire business model and way they and the way they work. Now some have done it very successfully, some have not been so successful. So also financial literacy has improved. Also the customer awareness. So if you read the press every month, we see some event where the customer has actually gone about making sure that the policy was fulfilled by the insurance company adequately, both on the life and the general insurance side. So there has been some form of even the customer awareness. Now in this environment, as I said, last 4 to 5 years, some insurance companies have done well and adapted to the change. Some have not done as well. But one player which has done exceptionally well in this has been on the life side has been LIC. So if I see for the last 4 years, in fact, interestingly, I was just seeing the statistics. So on the retail AP, and AP is the measure of annual premium equivalent, which is the measure for the new business in life insurance industry. So 4 years back, LIC had fallen to about 54% of the market in APE, and today it is up at 63. So while if you see from 2001 onwards, LIC was obviously that time 100 and moved down to 54, but now it's up to 63. So Mr. Roy, just the first point from your perspective. So obviously the business model, LIC has been less impacted than other players of all the policies, and you have gained market share vis-a-vis the other players. So how do you see what has LIC done, and how do you think a lot of the changes which happened in the regulation and the policies, especially in the life industry around the ULIP and now on the traditional products, how has LIC been able to rebound in some sense, and over the last 4 years rebuild the market share?
Actually, before I respond to the question Mr. Sharma has raised, I mean, we in LIC always feel, and maybe we feel it erroneously, that whenever any change happens, it impacts us most. So there is no need to debate over this question, but the facts, I think, largely suggest that we in LIC get very largely impacted by any change which may happen. Now, very specifically, question raised to me is what we have done in the last 4 years to regain market share. Mr. Sharma mentioned about the annualized premium model, by which our market share is approximately 63%, as he mentioned. But if we see it in terms of what reporting happens by IRDA on monthly basis, on the first year premium model, we closed the last financial year with approximately 85% market share in number of sales and approximately 75% market share in the first year premium. So we obviously feel very proud that after 14 years of the industry opening up, we managed to hold 75% of the market in terms of premium and 85% in terms of sales. What we have done to reach these figures, I think being a 57 or a 58-year-old institution, we always try to work on our core strengths. And I would like to, just to answer the question specifically, 3 core strengths that we always focus on, never lose sight of. First is obviously products. We've had an excellent track record of outstanding quality products, and in the new product regime also, I believe that our products are fairly attractive and competitive. Second core value that we have always been very concerned about, and that is the use of technology. Maybe because we have historically dealt with large numbers, there was a necessity to adopt technology in a very big way. It was not a luxury for us, it was not an option, but a fait accompli. So we have always focused on technology, and every day we try to do something new on the technology front. And the third is, which is very, very important, and that is customer service. We have always maintained very high standards of customer service, and that is, I think, one thing which gives us a very good brand equity in the Indian financial sector, I'm not saying only in the life insurance industry, but in the financial sector as a whole, the high premium that we pay for customer service, that has helped us maintain and to some extent regain our market share. So broadly, to answer your question, products, technology and customer service.
Sure. Thanks, Mr. Roy. So let me just shift gears and just have a perspective also the way regulations have evolved in the general insurance industry. And if you look at health insurance, and there has been and when health insurance in some form started in India in the mid 80s, when we had the product offered by the four nationalized players at that point in time, and in 85 with the Mediclaim, and over the period of last 10 years, health insurance has really taken off in a very big way. And I think the policy maker has played a big role in terms of trying to make sure that the products are standardized, the customer understands the product better. And what's happened also last 10 years is the boom of individual health insurance products, and unlike any other market in the world. So Mr. Srinivas, from a policy perspective, obviously the regulators talked a lot about what is the product all about, how should we standardize health insurance, have very simple products, but with the customer understanding improving, and so how do you see, I mean, the role which the policymakers have played in this amazing boom in the health insurance industry?
First of all, good morning to every one of you. See, as Shashwat mentioned, health insurance is probably the fastest growing segment in this country. And here, I mean, you have everyone here. You have the life insurance players, you have the general insurance players, you have the standalone health insurance players in this segment. And today, India has reached a situation wherein there is no family who can be without a health insurance cover. I think this is probably a product which every individual and every family needs very, very badly. India has done well in terms of advancement in medical technology and treatment facilities, but costs have gone up. If you really look at the way the product has evolved, you had the Mediclaim in 86, 87, and it served that point of time fairly well. For the last 10 years, a lot of new products have come into the market. The major change was the introduction of the concept of cashless, which was not there earlier. I think this has really changed the way the product is looked at by the people at that point of time. So there is a lot of scope for growth here. And if you also look at the way customers perceived it, I mean, probably health insurance was one segment which was giving rise to a lot of customer grievances. Even today, if you analyze the percentage of grievances a general insurance company gets, 70 to 75% is out of health insurance. This was because there was a lot of lack of understanding of the product, gap between what the insurer thought about the product and what the insured understood about the product. So this is here, I think the regulators stepped in, I mean, in a very eminent way a couple of years back. They brought about the health insurance regulations. They standardized a lot of things. They ensured the product has terms which are understood the same way by everyone in the industry. So a lot of standardization, a lot of terms which are customer centric. So the health insurance regulations has gone a very long way in making the whole product understood well by the market and reducing the grievances. So I think that way it has been a very, very positive development from the market perspective. Today with this base, the companies are now developing a lot of products. But a word of caution, I mean, today there are too many health insurance products. I mean, whatever one might say, the financial literacy in India is rather low. So I think we need to move to a step further wherein there are a couple of standard products so that it's understood easily by everyone. Then perhaps you can have products which are for the financially better literate people. I think that's how the market needs to improve. But nevertheless, the regulators played a very, very vital role. I think all of us should really thank them for that.
Yeah. And one very other interesting change of regulation and impact more on the non-life industry has been the entire dismantling of the third-party motor pool. And there have been a lot of talk about it for the last so many years, and now we're moving to we had actually moved to a regime of the decline pool. Now, the critics of the decline pool and also argue that there is always going to be some amount of adverse selection because there would still be a pool of vehicles which no private insurance company will like to actually take on its own book, and they'll use good technology analytics to make sure that you are able to identify a few good vehicles which you can then ensure that you meet the decline pool risk model. So there have been we have moved from the motor pool to the decline pool, and the experience has changed. So this is the question for you, Mr. Mishra. Is this a welcome change, the decline pool movement, or you think over the next few years we have some more food for thought and go back to the regulator with a different model?
Thank you very much, and good morning. Thanks to ET for inviting all of us, and thanks Shashwat for asking a question on the area which general insurers feel a lot about. Well, my personal view is very clear that third-party insurance, which is a mandated insurance, has to have a roadmap. We have moved from one end to another end, and your question of adverse selection, the regulator has clearly mandated that we can't refuse a single third-party policy, and all the policies are available on the web also. Notwithstanding, the level of understanding insurance is difficult for the transporters and the people who really need. One fact we always forget, that more than 50% vehicles on the road are not even insured today. So if you ask my view, the decline pool is a, what should I say, is just a stopgap arrangement, and the industry, I also know that if as and when it's opened up completely on third-party insurers, there will be bloodbath, but industry has to face it. When we talked about de-tariffing after privatization, there were apprehensions, but look at the sectors which were not tariffed earlier: liability, health, marine. They have grown much better than the sectors which were tariffed, like property, fire or engineering. Fire and engineering, which was almost 45% of the market, has gone down to 20%. Motor continues to remain at the 40%, but the rest, either liability has taken over or health has taken over. So look at the market dynamics. De-tariffing at the short term will always be a problem, but industry has to mature. So if you ask my view, again, right now, as Mr. Nair very clearly said, that's not an organization view and we shouldn't talk about organization, but since I worked for the industry and I understand the nuances, I'm of the clear view that if we can't declare that motor third party has to be a tariffed or non-tariff, there should be a roadmap 3 years or 5 years ahead, so that the market also knows, the people who are not insuring the vehicle, they also know, and the act which is coming, both Insurance Act and Transport Act, takes a view of it and decides how it's going to run. Because at the end, no insurance company can keep paying claims without understanding what is going in the kitty.
Sure.
So that's the view I have.
No, I think that's a very important point, because there are so many stakeholders, as you said, different bodies. We have the transport industry, we have the insurance industry, we have also the manufacturing industry, and whenever any industry is going to be impacted by a lot of other economic variables, the impact can always be underestimated or sometimes overestimated. So I want to ask you this question, Mr. Basu. Obviously, we are talking about in the realm of, in sense, what is the insurance regulator doing and what are some others doing. But what we've also seen is, I mean, there's also, especially in the life insurance industry, the AUM we talked about competes with the bank for the fixed deposit. The same AUM also competes with the industry from the asset managers and mutual funds. And at times, and now with the SEBI saying that they're going to also allow pensions in some sense to be linked to the AMC industry, that could be at some sense a threat. So a lot of times some of these threats come from, which are also policies in some sense. So some of these policies also might be impacted. And now you, I mean, work with as one of the largest, the partners of your company is India's biggest bank. So in some sense, that bank will also be looking at all the changes, and since the bank distribute so many products, including their own fixed deposits, mutual fund, other products. So how do you see with the policies happening in other industries also? Like for example, even this time in the budget, with the ATCs being increased to 1,50,000, but that has to compete with the PPF, with the PF, with the mutual fund, with the long-term FD and life insurance. It's not only for the insurance industry to benefit. So how do you see the policies in some of the other industries which is also happening at the same time, specifically also impacting this industry?
Thank you. I think there are two parts to what you asked. The first part, of course, is that how do we manage our assets under management, which Mr. Nair had also referred to in his speech. It's 22 lakh crores for the country. And the second part is the products of the life insurance industry. How does it compete with competing products from other financial sector players? I think as far as the first one is concerned, it's well understood that the fundamentals of the life insurance or any insurance industry is different from, say, that of a bank. And it's more of, in the bank we do asset liability management. In the insurance industry, it is the liability which has to be managed, and the assets under management that we have in any company, that has to be managed not only keeping in view what return we get, but the primary focus is on the risk that we are bearing, the ultimate policy that we are covering. It is the customer which has to be kept in focus. So I think the ability of a life insurance company to take risks in that way is limited and should be limited, because ultimately we are covering, we are taking a liability which will have an impact in the future. I think one of the things that will happen now is the capital requirements, I think, which Mr. Nair alluded to. At the moment it is basically your shareholders' capital plus a multiple of the risks that the life insurance company. In future, the asset side of the risk, the assets, the way it is being managed by the life insurance company, that will also be factored in, as will operational risk when we measure capital. What in banking we have Basu 3, I think going forward in life insurance we'll also have something like that. The other question which is probably more interesting is the competition that our products have with say a mutual fund or any of the banking fixed deposits and things like that. I think per se this is something which arises, the question arises even more in India, because even today, after a lot of growth in the industry which has happened, especially after opening up, insurance, the need for insurance protection is still not understood very widely. When a person goes in, otherwise a pure term product would have sold much better, that it is an expense, you need to insure yourself. It is still, a person would look at some kind of return, whether it is in case of a normal endowment product and things like that. And I think the challenge for us is to be able to explain to the customer that we have, this is the product, these are the essentially the features which appeal to you, this is why you should take it. But at the same time, do remember that when you are buying any product from an insurance company, the core element is that of an insurance. And I think when the ULIPs were ramped up, say 3 or 4 years back, where perhaps even the insurance companies who did that went a little wrong, was sort of put ULIPs sold by the insurance companies directly in competition with what is being sold by a mutual fund. I think now what has happened is there are certain distinctive features which have been brought into the products. You can't have a less than 5-year term and things like that. And ultimately the ability of the insurance company to be able to explain to the customer that this is why my product scores over the others, and having a core insurance element which is now mandatory will enable us to gain the confidence of the consumer.
So a very important point which you made is on communication of the product and the value of the product. And in the insurance industry, it is so highly intermediated so far. So it all depends on the channel. So I want to ask you a question, Dr. Nandagopal. Now, insurance in India is still always, more on the personal line. Retail is all sold through a channel. And as Mr. Basu said, the product being distinct from other financial assets and products is not very well understood by the customer and sometimes not even by the channel. Now the regulator and the policymakers have tried to bring in more transparency, ensure that the channel also gets better equipped. I mean, there's more focus on training of the channel. There's also more focus on the customer being able to understand the product with simple illustrations. But your thought in terms of has it really happened on the ground? I mean, is the channel distribution really able to communicate, and what more needs to be done both by the insurance companies as well as by the policy makers to improve this?
Well, I think, thanks for asking the question. I think the insurance product per se is pretty complex. If you look at them from the way it's been designed, it's been communicated to the people, because it's a long-term contract, at least from the life perspective. Because it's a long-term contract, you have to really cover different kind of clauses and contingencies. So obviously, the lawyers will have a lot of say in structuring the product and wording it in language which perhaps is manufacturer side, it's a slightly risky. But in that particular bargain, what has happened is the real intent of the particular product. When you look at that, any insurance product, whether it is life or non-life, essentially covers the protection element. So there is a protection, there is a savings, and there is a health, and there is a long-term wealth accumulation components of that, and that's perhaps everybody understands. I've been struggling in the industry for many years and tried to say that I am not a life insurance person. I do not sell life insurance. I do sell financial security, and financial security causes family happiness, and it gives comfort to the family if you are financially secure. And these words perhaps resonate with every person, every family. If you reduce it to that kind of a simplification, that would you like to have financial security, cover yourself and properly, adequately, and how do you translate that simple thought into a legally binding contract so that both the parties' mutual benefit are secured? Is a challenge, but the challenge is not something difficult to really overcome. I think the challenge is most likely, I mean, I perceive it's not in the act, it is not in the thing, it is in the minds of the people, because today you see that, even the most complex products can be very simplified designed, and most complex contracts can be properly written. From our perspective, we have done, we have taken serious steps to see that the product simplification happens both at the time of point of sale and subsequently in various customer interactions. The point of sale, ultimately, if you visualize the whole experience, the customers can connect better. So we have taken steps to visualize the product proposition through display of videos, and we can believe that, that the visualization of the thing can actually simplify customer. What he sees is what he gets. So that's something, which the companies can do it. Ultimately, unless you simplify and decode and demystify the whole proposition, then it will not percolate into the minds and the hearts of the people. If it does not percolate, how much hard you try, that the insurance should penetrate, and penetration should be more than 4 or 5 or whatever percentage you have. Unless it touches the lives of the people, unless it touches the thing, it will not happen. So it is fundamentally important that we have to simplify it, and simplification is not in the legal domain, it is in the business side. You have to start simplification.
So I think what you're saying is that once the product has been simplified, and obviously the policymakers can have some role in terms of just making sure that the product guidelines are more transparent, but ultimately the onus is on the insurance companies to be able to create the proposition which would be appealing to the customers. And the big a big channel which is to in the entire insurance industry is intermediaries. Now there have been a lot of discussions and debates in terms of should the industry move to an open architecture regime. There have been a lot of players who believe that they are significantly disadvantaged because some of the larger channels have already been tied up into long-term contracts. So if I look at LIC's agents, and they are more than 10 lakh, and they are always the high-performing ones. Because of the tied agency model, other insurance companies don't have the benefit of working with them. And similarly, if I look at the banks, because of the tied model, SBI only distributes the products of SBI life insurance or Mr. Basu. So if you're moving towards a model over a period of time, like in other, and obviously there is no clear roadmap whether it will happen in the next 6 months or will it take a longer time. But Mr. How do you see this? I mean, in case there is in some stage an open architecture, and obviously the people that have been talking about the banks, they're talking about independent financial marketers, they're talking about different ways. But if the LIC, because LIC has more than 10 lakh agents, they have been with the LIC for a long time, they have been really groomed. At some stage, if they are given the option to become IFAs, do you think it will impact the business, or you think the products of LIC, you said product technology in the beginning, that value proposition will still be able to compete?
See, it's a very, I must confess that the question is very complex, and it will be impossible for me to give you a straightforward yes or no answer. I feel that as normal human beings, there is always an aspiration to have something which somebody else has, which I don't have. Somebody like LIC has nearly 12 lakh agents, so there could be aspirations of others who don't have 12 lakh agents to have our 12 lakh agents. But we could also have an aspiration that we could have an exclusive bank marketing our products, which had a very strong relationship with us. Maybe the bank promoted us, and therefore it has total 100% commitment to us. So it's a question which is very, very difficult to answer. But let me put it. I want to suggest it. I want to suggest my response in a little different manner. We all admit that life insurance contract is possibly the longest contract in the financial sector. Possibly. Now, the question which arises that who is the best fitted distributor to address a relationship which is very long term? Is it a corporate entity or is it an individual? Experience shows that, and this experience is highly anecdotal, so therefore it's very difficult to draw out an hypothesis on that. That since it's a very long term engagement, individuals have tended to perform this relationship management role better than non-individuals. I reiterate that this is highly anecdotal and therefore very difficult to hypothesize. The converse is that this individual may not be as well equipped as a corporate entity in terms of skills, knowledge and abilities. So somebody has to create that good combination between a committed individual and a skilled corporate entity. Who is that? What is, this genetically modified creature, who is going to create? It's a very difficult question to answer. But we cannot overlook the importance of the institution backing the distributor. Ultimately, whether the distributor is an individual or a corporate entity, what matters most is whom does he represent. Now, if he is representing an entity which is considered to be reasonable and reliable, the distributor, whether corporate or individual, tends to perform his role better. The converse, I need not say. I think that can easily be understood. If the question put to me, if it was a very simple, and I have taken a long time to answer it, and you may feel that I have not been able to answer it, I am saved by the fact that large number of committees created by IRDA and by other regulatory systems have gone into this question, and till today we don't have clarity on this subject. So what I can say by way of summing up is that maybe at some times and in some contexts we are placing too much importance on the nature of the entity. Maybe it is necessary that we go behind the entity and see who he represents, what does he stand for. I think that may lead us to a better understanding of the question.
Sure. So, if I were to ask a little variant of the same of the question to you, Mr. Basu, because what we've seen is that most of the, at least on the banking side, the banks have moved to, at least on the other financial services products, to an architecture which is fairly open. For example, if you look at even on the mutual fund side, the banks are distributing almost every fund house's products, and similarly, so the customer is at least given far more choice. There has been also some draft guideline. Obviously, we're still waiting for final clarity from both RBI and from IRDA on the change of the policy. But from the customer perspective, if an open architecture is given and where the intermediary is a very savvy entity like a bank, which obviously understands investments and saving much more than individuals. So, do you think that will be a change which the industry as a whole, I mean, I'm not talking specifically for SBI, but as a whole, will that industry will welcome that?
Yeah, I'll respond to this going a little back. When we opened the insurance sector, again, why did we do that? I think there'll be fair unanimity in this room that there were two fundamental things in view. One is to able to reach out to many more consumers, and where India was lacking, and to a large extent, I think we have started on the right path. We have a long way to go. The second, I think, was to keep the customer centricity in focus. It's not just how well the companies are doing, but ultimately whether what the companies are doing are benefiting the ultimate consumer. Now, if we look at these two parameters, and if we see the way, I will confine myself to private players, because LIC, as we all recognize, has done very well in this competitive environment. As far as the private players is concerned, if we look at how they have evolved, we clearly see that some of the companies have tended to do better. And the reason which I feel they have tended to do better is not who is the promoter, but how well these companies have been set up. Maybe some part of the good governance has come because their parent companies are very well governed, and the ability to reach out to the consumer through different distribution channels has happened as that particular entity has decided to do. If I look at SBI Life, the first thing that would have come to anyone's mind is that SBI has set up life insurance subsidiary, and they would only use the bank distribution channel because SBI has today 16,000 branches and 4,000 associate banks, 20,000. But what is the reality in our company? In our company, both the channels at the moment are actually delivering, it's 50-50. The retail agency channel delivers 50%, 50% is delivered by the bank assurance channel. We know that we are possibly a huge potential is still to be delivered within the bank assurance channel. If we look at this question a little more deeply, how is it that SBI Life managed to also have a fairly decent retail agency channel? I'll answer that question with how LIC has succeeded. If LIC has 12 lakh agents, and even after opening up of the sector for 14 years, these 12 lakh agents have decided, primarily a large number of them have decided to stick to LIC. They must be for very good reasons, which a governance or the governance is, I'm using the term loosely, which they have managed to do. If we have managed to build up a retail agency model, much more modest, but to some extent successful in some certain areas, we must have also done certain things right. So, I am just giving this perspective when we answer the main thrust of your question as to whether we should have full open architecture. I think ultimately the choice, as I said, is what the customer decides to have. And if we want the insurance companies to do well, to be able to reach out to the customer, I think when we talk of customer choice, we must have a choice for the insurance company to decide on the model that they wish to have. When we talk of, you were mentioning a larger number of products being available, the market is open. All the products that are available in the market, it is not necessary that only the bank assurance model needs to market that. If X product is better in available, whether distributed through any channel, and if a customer feels that he will not buy this product but buy the product of another company, he will use the model, he will use the channel that is available. Just one further point. When these companies were set up, and we are talking of a very nascent industry, hardly 13 or 14 years old, everyone had a business model in mind when they gave it. Now, if our reason for shifting to open architecture is to keep consumer interest in mind, we need to examine more deeply whether that would come. If it is to keep the interests of the companies which are not doing well in mind, I think that is not the right way to approach this problem, because it could have deleterious effects on how the industry can grow forward in future.
So what I hear from both Mr. Basu and Mr. Roy is that as long as we are being customer centric and company thinking about the customer's endpoint, and the customer will ultimately be able to find the right product. Though Mr. Nandagopal did say that in terms of just the financial literacy and understanding of the product complexity, the channel plays a big role. Now, what we have seen is, at least on the simple products, we've seen a good advent of online distribution and other channels. Very interesting statistic I keep hearing every time, that India has got more mobile phones than bank accounts. India is the internet capital of the world in the next few years. So Mr. Mishra, you've have had fair success on the travel insurance, and you are the leader in that segment. But that segment has been small; it's not grown as fast as it should. But even if you look at the motor business and the motor renewal, that's again something which globally is a very well accepted model, where the customer, and it's very simple. So if I look at even an AIG Direct or a Geico or any of the global models, it's very simple. For the lowest cost, come and on this site or dial this number, and you get the lowest cost insurance. And obviously then the insurance company does a lot at the back end. The policy allows it. There are good global models around it, but somehow, and obviously I'm not talking about the complex products to be bought online, like health can get complex, but simple products like motor haven't really taken off that much like it could have. So any thoughts? I mean, is it something to do with the policy, or is it with the customer mindset, or something else?
I'll take a minute on this. Mr. Nair made a very valid remark, recklessly prudent. India is the only market where comparison of policies and comparison of rates is still not permitted. The insured, or the person who wants to insure, he has to go look for the different products and then decide. LIC is very right when they say that it's a long term and people have to understand, and I respect LIC for what they have done in the country. But look at the two sectors. One is reading habits, another is retail market. When Bansal started Flipkart in India, only 5-7 years back, nobody thought that it can be a success, or Alibaba for that matter, or Amazon for that matter, or for Google for that matter. What I'm looking forward in 10 years' time, and very point well made by my colleague, it's at the end of the day, the customer is the king. Yes, we are providing service, we are trying to be customer centricity. But generation Y, which is going to rule the roost in the next 10 years, are they ready to wait for the agent to come? Today, look at general insurance. I'm not talking about life insurance, because the long term still agent plays a big role. Today, I know an individual, if he wants to insure his car, it's very difficult for him to get an agent. And if he wants to insure a scooter, it's almost impossible. So there are two ways of looking at. One is the major cities, there is a possibility. Rural area is still very far off. We always crave about penetration, but there is a problem with the distribution general insurance industry, particularly because the borrowed distribution has not worked as it should have. So my point is, open architecture probably in the general insurance industry is a cry. It will take time, but it will come. Your question on the travel insurance, yes, we started digital insurance almost 10 years back when we started travel. It has moved up. It's not that it has not moved up. I would not like to say the numbers, but it has moved almost 10 to 12 times than what we started. Auto, we are already seeing a good hit on the renewal part, as well as on the what you call buying the insurance. But the problem is the customer still has to go to 4 or 5 sites, websites or companies to compare. And for that reason, he just, whosoever approaches him first or whoever approaches him persistently, he goes with them. So I will again go back to Mr. Nair. Probably time has come that there has to be, whether it will be right or wrong for the industry, it's difficult to say. Again, it's all anecdotal, but my personal experience of international market is very clear. The net will play a big role, and in 10 years' time, probably we will be talking something different than what we are talking today in this office. That's all I can say.
So you made a good point in terms of quoting what Mr. Nair said about what the regulator should look at in terms of the approach. But one thing which the regulator has done, in fact, in 2013, when the health insurance guidelines came in, they said they will allow a combo product for a term life with a health insurance product. Micro insurance, it's been now almost 7 to 8 years when you could work on a life and a general insurance product together. But somehow there have not been too many takers on this one. So I'll take both Dr. Nandagopal, because he represents the life industry, and Mr. Srinivasan. In terms of the combo product, it's been a guideline for almost now 2 years. Not too many products in the market, not too many innovation. The idea was, can you integrate an indemnity-based health cover with a term life cover? Good thought, because a very simple product construct in that sense, but not too many takers. So, Srinivasan and Mr. Nandagopal, your views?
See, basically there are fundamental differences between life insurance and general insurance. Probably that could have been one of the reasons why this did not take off, even though it was conceived with a lot of good intentions. But a more important reason is again on distribution side. See, if you have a combo product, one is not sure who will distribute the product, who will service that product. So there are a lot of contradictions in the way the product was structured and the product was received in the market. That is probably why this product did not take off. I mean, this again brings me, let me go back to this question of distribution. See, as a long-time insurer, I feel that insurance is not just distributing products the way probably toiletry products are distributed. This is how I think I have heard many people talking about distribution of insurance. Insurance is not only giving a product, it also involves servicing a product. And the biggest problem why there's not much of penetration in our country, one of the biggest issues is trust of the customer on the insurers. I mean, there is still a gap between, what the insurer thinks he is giving and what the customer thinks he is getting. So I think distribution is probably a very critical area where the Indian insurance industry has to focus if it really has to increase the penetration. Now, talking about the open architecture or closed architecture, all models are available. So I don't know why we should really go only for one model. If you talk of agents, why would an insurance company recruit and train agents if it's going to be available for everyone? So it has to be a tied architecture. You have brokers who are an open architecture. Talking about bank assurance, my personal opinion is banks have to take responsibility if they want to be in insurance. Insurers are not allowed to be in the banking space. Why is it that banks want to be in the insurance space unless they take responsibility? So they have to take the responsibility of a broker, be accountable to the customer if they want to be in this space and earn some remuneration. They can't just get away by being corporate agents and earn remuneration but not being accountable. So distribution is very critical, and I think that's one of the reasons why this combo product has not really taken off.
Well, thanks, Mr. Srinivasan actually very succinctly has summarized. I'll just pick up 3 points maybe my colleagues have actually mentioned. One is the digital challenge, which my colleague has been mentioned, that how in 10 years time the internet will change. Mr. Srinivasan has mentioned that why the combo products have not really taken off is because while manufacturers are different, the distributor is not really competent enough to perhaps reflect the product complexity of both. So fundamentally, I think let's look at that customer has a bundle of needs, and customer is looking at somebody who will fulfill those bundle of needs. And if that fulfillment happens in the simplest of fashion, in the most trust-free, hassle-free manner, then I think the industry will be better off. So there is no debate, I mean, that, if customer has a bundle of needs, why can't we fulfill those bundle of needs? Just because the regulations are different, just because the distribution channels are different, just because tied agency versus bank assurance and all that kind of, things which you have it, are creating those silos. So I think, if you take the example from any other industry, let's say telecom, the telecom is actually given as an excellent opportunity. In the phone now, you have got almost everything else bundled together, and somebody sells it together as a phone, but he's selling a camera, he's selling a radio, he's selling a computer, he's selling everything together, and he's equipped to handle it. So I think, ultimately the digital India will create that kind of a bundling of needs coming together, and it will completely dismantle these artificial barriers. That digital India, if it does not happen, whether in the insurance sector or something, it is already happening in the banking sector. We will see that kind of universal banking and others is happening. So combo products is not a product, it's basically bundling of those needs. So it is possible for a distributor or a platform or some sort of a technology which will integrate and give that kind of a unified, sustainable and reliable experience. Because if that kind of reliability is not there, then basically the manufacturer will ultimately take the flak for some kind of a service delivery. So that is the way, I look at it, and it will definitely happen. It has happened in other parts of the world, and it will happen in India too.
Thanks. So you talked about what's happening in other parts of the world, what's happening in India too. So if you look at some of the global models which are a lot more advanced, typically insurance companies are actually called manufacturers in a lot of countries, and then you have the distributors who have an open architecture. So typically the distributor or the broker will say, okay, fine, I think the best liability product is from company this, the best the employer benefit is from company Y, and then the distributor stitches everything together and brings it to the customer. There is no brokerage which the insurance company is giving a distributor, but it's actually done by the customer. Now that model, Mr. Srinivasan, does it look a little too far-fetched in India next 5 years, or with the way the market is growing and the way there is a lot of discussion about who should be paying the commission, and as we heard, the customer is king or queen in whichever case. So, do you see this next 4 to 5 years, this at all happening, this open architecture, or you think at least next few years it will take time? And this is not for you, anyone in the panel, please give your inputs, because global regimes are moving in this direction. Do you think India is ready, well poised, or still some time to go?
It's probably the best that can happen to your customer if he pays the intermediary. But I don't see this happening the next 5 years. It has not happened even internationally. Even in US, about a decade back, when there were issues of, commissions, overriding commissions, brokerages, at that point of time, also this was discussed. But today we have just reached the level of transparency in those markets. In India, if the customer has to pay a brokerage, I think he will dispense with the intermediary. So he would rather come to the insurance company directly. So this is probably an ideal we should reach, because then only the customer can really demand service from the intermediary, and probably his interest will be taken care of. But I feel it's a decade away.
Any other views from the panel
Actually,
members?
the customer is paying indirectly as a part of the product price is the distribution cost, and whether manufacturer pays it or not, ultimately there are no free lunches. Customer is paying, but if it is bundled as a part of the cost within the product, he is not aware of that. The moment it is broken up separately, he is aware of that. That's where the entire resistance comes. I fully agree with Mr. Srinivasan. The moment you see something, as a separate entry, without even realizing perhaps he is well prepared to pay it, but the moment he realizes this is the cost which is prepared, then he somehow finds a way to do a direct.
Well, I'll not comment over live because that's completely different market. But what I look at general insurance, the way the market is changing, the broker's role has been limited to either commercial line or group accident, which constitute now about 32-33%, which is going down, it will not go up. So the 80% in next 10 years time will be consumer lines, which is individuals. Now, that's the challenge in general insurance industry, and then the question comes, why term insurance, whatever little I know as anecdotal again, why term insurance is picking up on the digital platform? Because the customer knows that he is not paying anything extra. Same thing will happen in general insurance industry, the digital, if it moves in the right direction at the right time, the role of intermediary will completely change in general insurance industry, so far the consumer lines are concerned. Commercial line, brokers will roll the roost. The only thing will come that the liabilities will also be attached to them. They cannot escape the responsibility of distributing a product but not owning it. That will also come in this country.
Yeah. So I think that's a very pertinent point which you made, in fact, Mr. Srinivasan made earlier and you also to Mr. Mishra in terms of the fiduciary role of the distributor.
Yes.
And I think the regulatory regime across the world is focusing a lot on that. And there's still a debate happening even in the Indian context in terms of what should be the fiduciary role of the distributors, and that's one clear action item which we see for the policy makers in the country. Also, there's been a lot of discussion and debate over the next. I know 2008 was when the insurance amendment was first drafted, and it's been 6 years. Now it's I feel very embarrassed saying that in the next few weeks or months I hope something will happen, so I'll not say that, but when it happens it talks on a few disruptions in the draft, including setup of very small regional health insurance company. For example, if you look at in the draft which was in 2008, like we talked about that you could actually start a health insurance company with as low as 50 crore of capital. So which means you could be a small regional player, take the city of Mumbai, Pune, 2-3 cities, build a network and build a company. Also, if you see in terms of the entire motor amendment which may happen, so there are a lot of things in the insurance amendment which go lot beyond what FDI is often talked about. But do you think, open to the panel in terms of one or two things which you think will positively impact, and maybe one thing which might, I won't say adversely impact the existing players, but because whenever change happens, it's how fast people adapt and make it work. But at least any thoughts if the Insurance Amendment Act goes in the form as it was in 2008? Anything? Maybe you want to start, Mr. Basu. Any thoughts on that?
Yeah, I think as you rightly said, this proposed bill is much more than what is debated in the newspaper. Newspaper only writes 49%. I think the 49% is important in the sense that when the sector was opened up and players came in from outside, they came in not only with large value of capital, but also technology and things like that. So if that is permitted to a greater extent, broadly it should benefit the industry. But from the life insurance perspective, I think there are again two things which I will come back to. The purpose of opening up or having a new insurance bill, I think primarily is twofold. In India, it is a country which is underpenetrated, underserved. So how many more people you can serve? That is one. And second, while this process of reaching out to more people goes on, you also need to keep in mind that the customer's interest, that is what we call a customer protection, is actually served. And to my mind, that is best served if we are able to use the insurance bill in such a manner that institutions or companies that grow in a manner which is sound. Rather than, and the choice, ultimately, if we do that in the right way, it will be the customer who will determine the choice. He is the ultimate person who buys the product. So all other debates that crop up, like things like what is the ideal distribution channel, things like that, if it is the company which will determine, certainly certain things if a company does which is not in the interest of the consumer, the regulator is there to step in. But broadly, any change which is in these two directions, serving our ability to penetrate to more and more customers, and at the same time have products which protect the interests of the customer. If these are served, and I feel that the insurance bill should be a step in the right direction.
Any thoughts?
There are three basic changes I just would like to highlight. The first is there's a lot of flexibility given to the regulator. I mean, today there are a lot of things which are hard-coded in the Insurance Act. The regulator is not able to do anything. So I think the new Insurance Act gives him a lot of flexibility to administer the insurance market in a way which is good for, conducive for development. The second changes, which is probably not spoken much, is the change it's going to make in the reinsurance. Maybe it's not spoken because it's not understood by many. There are going to be foreign reinsurance companies operating here as branches, which is today not possible. We are talking of allowing Lloyds coming in here. This could really create, opportunities for India emerging as a reinsurance hub in this part of the world. So that's a great opportunity. The third change is obviously there are going to be more insurance companies, which is good for the customer.
Well, I think, when we're talking about the policy changes, the most important policy change will also have to happen at the internal level. Like Mr. Srinivasan has mentioned, that the hard-coded law moving away from the statute book to the regulator's office is definitely the welcome change. But within the regulator's office, also the policy changes have to be friendly, and then perhaps we have seen too many policy changes in the last 2-3 years, and especially in the life side. So many changes have happened in the regulation side. So that kind of a thing perhaps is also somewhat, difficult for the industry to manage. But moving the policy change from the statute book to the regulator's office is definitely a good thing. But the regulator's office should actually look at the industry's interests and then develop the most well-meaning and somewhat stable policy regime so that the industry will have time to settle down to the changes. Otherwise, too much of a frequency with which the policies have changed will have its own debilitating effect on the industry. That's what my view is.
The only thing I would like to say that, okay, we are talking about insurance bill and the changes which will encompass. After what Srinivasan has said, I don't want to add much on the bill per se. But what I would like to add, because the select committee is having such a diversified view amongst themselves, that what exactly is going to come final is still a question mark. That is point number one. Point number two is the end of all, because the example which we have of the companies law, companies bill which has been passed and which is we all are struggling with, if that is an indication, I only wish that the insurance bill doesn't come like that. That's all I can say at this stage. And third and not the last thing, I will say that again, Dr. Nandagopal has made a very valid point. Make any rule, make any law. The person who is going to administer, he also has to understand he can't be recklessly prudent.
Absolutely. So what we really heard is a lot of promise.
I would like to hear from Big Brother.
Who is he? No, I think all has been said.
Yeah, that's true.
So, I think the volume just went up because I think we have to open it to the audience. So I think it should go up over there rather than over here. So something wrong with the mic. Yeah. So what we all heard is in terms of the future, and the way the policy maker is thinking over the next few years, trying to have global convergence on the entire model, because at some stage we would be converging to international standards of risk-based solvency modeling. We will have to converge on the accounting standards. There has to be convergence also at the overall regulatory framework. And one of the biggest thing which the regulator talked about, even across the world, is about the financial inclusion and making sure that more people are included in this fora. So hopefully, with some of these channels opening up, and India would be also able to take this model on financial inclusion. But before I open to the audience, just one quick question for Mr. Roy. LIC has done such a phenomenal work on financial inclusion. Just making, more than 200 million Indians hold policies. Like almost 20% of India has some policy from LIC, and it's such a phenomenal model of financial inclusion. So some of the learnings which you think how you made it work, because a lot of other players across the world are now looking at LIC. Because a lot of discussions I have with a lot of global insurance companies on financial inclusion. they all say the LIC has really a lot to learn from. So any thoughts before we open to the audience from a future perspective, what the policy could help further financial inclusion and also building from the model which we have done for LIC?
Fine. Just a small correction, if I may be permitted in the figures. I think we now serve approximately 33 crore policies. So that's about 330 million Indians. Maybe factor it down, it would be 300 million or so. Now, see, there are a couple of reasons which explain our track record in financial inclusion. I have always, since morning, whenever I have responded, I have said that products are very important. And we have always had products which were comfortable for the bottom of the pyramid. So that was historically one of the very important reasons why we could do well in financial inclusion. The second reason, which I have mentioned earlier also, which is relevant here, is that our distribution and reach. A large number of our offices are in tier 3, tier 4 towns. It gives us scope to reach those geographies where we get access to the bottom of the pyramid. So that's the second thing. Third, and very important, is that we are very privileged that whenever a large social security scheme is launched by state governments or by the government of India, LIC is often called forward to manage that scheme. So that gives us a very large reach. Of course, that's not individual policies, that's on the group platform, but still it provides insurance coverage to a very large number of people at low cost in terms of time and energy spent. So I would say that these are primarily the three reasons why we have had a good track record of financial inclusion. And I think everybody, the fourth reason is that everybody expects us to do that. So I'm sure that this expectation of everybody on us will continue, and I hope in the future also we'll do better than what we have done in the past.
Thank you so much. So we have the house open for any questions. So if I would request the person who wants to ask a question, raise your hand, and my request is I would request no one to summarize what has been discussed. Just ask the question straight, because we only had 10 minutes. So if you could just ask the question directly, and you could either pose it to any one of the panel members, or you could ask me and then I could pass it on to the member.
Sir, I heard a lot about the introduction and growth of the health insurance, but what I feel that this nomenclature itself is a defective. It is not taking care of the health, but the disease conditions. So what are the plans industry is having to encourage the preventive procedures, which is far cheaper than the curative procedures which we are covering at present? One. Number two, common for health and motor both. In view of the less effective distribution channel, what is the scope or hurdle for the long-term cover of say 3 years to increase the penetration and coverage, particularly in view of the amendments in the pipeline for Transport Act and Insurance Act?
So you asked two questions. The first question which you asked is in terms of why is health insurance not preventive rather than curative? That's one question you asked. And the second question you asked is in long-term cover for motor and health. So the two questions on live. I would request Mr. Srinivasan and then Mr. Mishra can take the second question. First question is in terms of
in terms of preventive covers, I think this is where the industry is now moving forward. I think industry in its first stage of development focused more on treating diseases, giving compensation or indemnity covers for taking hospitalization benefits. Now I think as a second stage, companies have already started moving into wellness, building wellness covers as part of insurance policies. You are now seeing it in group health insurance schemes. Today, many of the big corporates are not only talking of hospitalization cover, they are also talking of wellness being built into it. Now it's also being built into the individual covers. I mean, we already have in the traditional health policies, I mean, once in 3 years or 4 years, we give reimbursement for going for a health checkup. So this will now become a larger part of health insurance. I think that's the way the portfolio will have to move and will move.
It's on the long-term cover.
Long-term cover is already the pipelines, two-wheelers have come, and I think it will not far off. But there are accounting problems and valuation and the reserving problem. We'll counter it. It's not difficult, but that's not the question. The question is, it's a mandated insurer, but half of the people in this room, if they have a two-wheelers, they don't have insurance. So it's again, it's a question of understanding the implication of not having insurance. Distribution has to improve. Long-term policy will come, but as the economy grows, the cusp will change and the people themselves will understand why they have to buy a mandated insurance. So I'm very hopeful it will happen. And to add to Srinivasan what he said about the health care, again, as a contrarian view, people are not even paying for sickness. Very few people will pay for wellness. That's all I can say at this stage. Just on a lighter side, not a serious note.
Sir, can we allow this, say, the agencies
I'm
which
sorry,
are
if you
responsible?
don't mind, I will actually have a little more questions. If you don't mind, I mean, is it a third question or is it linked to the?
Linked to this, sir.
Okay, so
For distribution channel, can we give the responsibility to other agencies like petrol pumps for checking the third-party insurance? Everybody is going to fill up the petrol at pump.
Lots of things will come. Let the new bill come. Lots of things will change. The regulator already has come with what you call district level entrepreneurs. So things will come. Don't worry about that. That will come.
you have the mic, so you have the question.
Hi. Good afternoon. This morning we discussed about life, health in general. One miss which I found was on pensions. I think the need for pensions is immense. At the same time, what has happened in the last 7, 8 years, 6 years, because of regulations, at some point of time, pensions used to contribute almost 30% of the life insurance industry business, which has fallen now to kind of sub 5%. So that seems to be one case where regulations have really impacted maybe adversely. I know PFRDA is there, but at the same time, having said that, if the customer is not benefiting because of the regulations, I think there's a miss there. I don't know what is the view of the panel here.
Actually, you're right. I mean, this is one of the segments of the industry which is heavily underpenetrated. There is huge scope for business here. There are two ways in which obviously this could be attended to. One is through the individual pension products, and the other is on the group platform. It could be making better business sense from an insurance company's point of view, that if there is an organized group, then a group cover is provided for, because that would enable more efficient coverage of larger numbers of people. The individual pension is a market segment, but the product is little more complicated than an ordinary endowment or a life insurance product. So to that extent, the distributor has to be extra trained to explain the features. There may be some difficulty in having large volumes on the individual pension front, but definitely on the group pension front, there is tremendous scope in this country.
Yeah, my question to the panel is that Mr. Roy spoke about products, use of technology and customer service being the differentiator for LIC. I think what IRD has done recently is also to accentuate and accelerate the customer service, talk about opening of EIA accounts. Now that's a very smart use of technology, plus has a very long-term view of customer service because there's agencies managing it. And I know the industry as a whole has had a very lukewarm response to it. And we all know who the big brother in life insurance is. And it'll be good to hear from the panel what is the industry view on taking this forward, because if this were to go through, then the digital, dream that Mr. Mishra was talking about would come in very handy because the documentation simplification is done.
Dr. Nandagopal?
Well, I mean, I have opportunity of working on the particular project. I think, I mean, the industry definitely favors. I can actually say maybe Mr. Roy himself has very clearly, categorically mentioned that, being the largest insurer, industry welcomes. The fundamental issue is the cost. The fundamental issue is that if it is a duplicative cost, you have a manual processing cost, manual policy issuance cost, and then also you have to pay for the insurance repository cost. Then I think it will actually loads up and somebody else has to pick up the cost. I think that's why the committee which has been formed by the IIDA looked at, I mean, how do you make it mandatory? And when you make it mandatory, customer will have option of choosing which one he wants to do that. And if there is a differential in the cost of manual process versus digital process, the customer should be prepared to pay for that. And if that happens, I believe that, I mean, the digitization of the whole insurance accounts will significantly reduce the cost, and eventually that is the way to go about it. And to facilitate that, apart from making it mandatory, there is also process reengineering we have to do it. Today, unfortunately, the process has been extremely cumbersome, and once the moment, I mean, you make it, I mean, very, very simple, the cost can dramatically come down, and I believe that on behalf of the industry and everybody else will support it, and the customer will be the biggest beneficiary.
There's one small suggestion on that if the industry could take it up, which is that the secured login of each bank account can be actually used to, complete this process, and we could actually have all the bank account customers turn into EIA account holders as well. And then the penetration of insurance would go up.
That's been one of the recommendations.
Great, thank you.
So we have time for one last question to the panel. Okay. So thank you so much. This was a wonderful session, and thank you so much to all the eminent speakers. It was a very engaging discussion, and we have a lot to think through as the industry is poised for the next phase of growth over the next 5 to 7 years. Thank you so much to the panel and to the audience.
Thank you to the